You know, we're always told that mutual funds are this simple, easy way to build wealth, right? But what if I told you that's, well, not the whole story? For most people, it's actually a path to failure. And we're going to dive into exactly why, because the data, it tells a really shocking story. So here it is. This is the number that just blows my mind. A staggering 90%. That's right, 9 out of 10 people who put their hard-earned money into mutual funds, they just don't end up creating any real life-changing wealth. They start off with these big dreams, but in the end, they have very little to show for it.
And this is where it gets really puzzling. We're talking about a massive industry in India worth over $600 billion. Money is just pouring in. So the big question is, why? Why are so many people, the vast majority, not getting the results they signed up for? Well, the answer, it's probably not what you're thinking.
All right, so let's get right to it. What's the number one reason for all this failure? You might think it's picking bad funds, or maybe a big market crash. Nope, it's actually something way, way simpler. People are just quitting the game too soon.
I mean, just look at this data. It's pretty wild. A full 90% of investors pull their money out within the first 5 years. Let that sink in for a second. Only a tiny fraction, just 10%, actually stick around for the long haul. It's like a mass exodus from the market.
And if we break it down even more, it's kind of shocking how fast this happens. In just 2 years, poof, 70% of investors are gone. By year 5, like we just saw, that number jumps to 90%. People just aren't giving their money the time it needs to actually grow, which of course leads to the next big question. Why are they leaving?
Well, it's because investing, you see, isn't just about spreadsheets and numbers. It's about psychology. It's about how we're wired as humans. There are these super common, predictable mistakes that our own brains trick us into making, causing us to panic and sell at the absolute worst times. Okay, let's play out a classic scenario. The market drops 10%. The panic investor looks at their portfolio, sees all that red, and immediately freaks out. They stop their SIP, their systematic investment plan. But the smart investor, they see that exact same 10% drop and think something completely different. They think, awesome, the market is on sale. So they keep investing, snapping up more units at a cheaper price. See? Same event, two totally different reactions that change everything.
And here's another trap we all fall into. Let's call one investor the gambler. They see some fund that did a crazy 40% return last year, and they dive right in, chasing that high. Then you have the goal setter. They couldn't care less about last year's hotshot fund. They're just consistently putting money into a solid fund that's lined up with their actual goal. Like retirement in 20 years. One person's chasing a thrill, the other is methodically building a future.
And the list goes on, right? You've got people investing with, no real goal in mind. They don't even know why they're doing it. Or they end up with like a dozen different funds that all basically own the same stocks, which just creates a messy, inefficient portfolio. And then there's the classic, going all in on high-risk stuff, and then panicking the second things get a little bumpy. It's a total recipe for disaster.
Okay, so we've talked a lot about the problem and the psychology that drives it, so what's the fix? Let's talk about the solution. And honestly, it boils down to one single, incredibly powerful idea. It's the one thing that the successful 10% understand deeply: patience.
Here's the key thing you've got to understand. Long-term investing isn't one long straight line. It really happens in 2 phases. The first, say 10 to 15 years, that's what I call the patience period. And honestly, the growth feels slow. It can be super frustrating. But if you can just stick it out, you enter the golden period. And that's where the magic of compounding really kicks in and your money starts to grow like crazy.
So let's make this really concrete. Let's say you start an SIP of just 10,000 rupees a month, and we'll assume you get a pretty standard 12% average return a year. Let's see how this actually plays out over time. Okay, so after 3 years, you've put in 3.6 lakhs and your profit is around 75,000 rupees. I mean, let's be honest, that's not that exciting, is it? And this right here, this is the exact moment where most people give up. They see that small number and they think, this isn't working for me, and they pull their money out, they quit, right in the middle of the patience period. But what if you just don't quit? What if you stick with it? Let's jump forward to year 15. You've made it through the entire patience period. Your profit now? A whopping 32 lakh rupees. Now we're talking. This is what real disciplined investing can do. But believe it or not, the real magic,
is just getting started.
And this is where your jaw is going to hit the floor. Just 6 years later, so now we're at year 21, your profit has exploded to 80 lakhs. Just think about that. You made almost 50 lakhs in profit in just the last 6 years. That's more money than you made in the entire first 15 years combined. That, my friends, is the golden period. That is the power of patience.
So, the big question is, how do you make sure you're in that 10%? How do you actually get to that golden period? Well, it really comes down to following a simple, straightforward playbook.
It's basically 4 simple rules. Rule number 1, invest with clear goals. You have to know why you're putting your money away. 2, get a handle on your emotions. When the market dips, don't panic. Try to see it as a buying opportunity. 3, trust the process. You got to believe in the power of compounding and understand that real growth takes time. And number 4, and this is the most important one of all, just stay invested.
So when you boil it all down, the final takeaway is actually pretty simple. The problem isn't the mutual funds. They're just a tool, and a powerful one at that. The system works. The real variable is us. It's our own behavior, our emotions, our impatience that messes things up. The power to succeed, it's really, truly in your hands.
And just a quick reminder, of course, that this is all for educational purposes. Mutual fund investments do have market risks, so it's always a good idea to chat with a certified financial advisor about your specific situation. Thanks for watching.